First of all, discounted cash flow. This is one kind of valuation, otherwise called as absolute valuation. The other group of valuation which we come across is the relative valuation, where we compare a few ratios across the various companies. We don't do any kind of projections or something like that. Whereas in the discounted cash flows, it's looking at the company, the industry, the performance, and based on that trying to arrive at the value of a particular firm. So, first of all, in this word, discounted cash flow, the steps for me are, first tell me what is cash flow. What is the definition of cash flow? As an equity investor, right, if I've bought a share of a company, the major benefit or the cash flow that I am getting is nothing but dividend. Right? If I sell that share, probably there is a capital appreciation on that. But if I am holding on to that share, the only benefit that I am getting is in the form of a dividend. So, for me, the first definition of a cash flow is a dividend. But of course, because the dividend is guided by the dividend policy of the company, and in some cases, even if the company has generated an extraordinary profit, it may not distribute the dividend. So because of that, we really wanted to identify what is the dividend paying capacity of the company. To what extent, what is the cash that is available with the company to pay the dividend. Whether it pays or not, let's keep it aside. But what is the level of cash that is available with the company to pay towards its investors, whether it is debt or equity investors? So that's also like the dividend paying capacity. Think of it from that dimension. It's not the dividend, but the dividend paying capacity of the company. So that is what we are calling as free cash flow to the firm and free cash flow to the equity. So that is one thing we are defining as a cash flow. And in some cases, we will be defining the residual income. The profit that the company has generated, the net income the company has generated above the expectations of the investors. We'll talk about it in detail, but these are the three different definitions of cash flows. I can have dividend as the cash flow, the free cash flows, and the residual income. So once I have decided this is the definition of the cash flow, I have to forecast them for the next few years. For the future, I have to forecast those cash flows. Then identify a discount rate methodology. What is the basis for discounting those cash flows to the present value? What is the discount rate that I have to use? On what basis I am going to decide on that discount rate? And once I have identified it, calculate the present value of the future forecasted cash flows and say that that is the value of that particular firm. That's the typical thing that we do in any DCF analysis. So whether I'm dealing with the dividend discount models of this session, or I'm going to deal with free cash flow based models of the next session, or the residual income models of the next another session, in all of them, the process that I'm going to follow is the same. I have to forecast the cash flows. I have to choose a dividend rate methodology and find out how much should be the dividend rate, estimate, discount the future cash flows to the present value, and define that as the value of the particular firm or investment. So let's get into this dividend discount model. So here my definition of the cash flows are dividend. And because the dividends are cash flows to the equity investors, the discount rate that we are choosing here is the cost of equity. Because this is a payment to the equity investors, and I'm discounting them with the return that the investor requires for this investment, the minimum return that the investor requires for this particular investment. And first thing, dividend is the only cash flow for the investor if he has invested in the stock market. If he had bought the share of a company, there is nothing else that is received by the investor as long as he is holding the stock. Don't say that he can sell the stock and he can get the capital appreciation. Then he is no more an owner of that particular stock. So as long as we are talking of the ownership remaining intact, dividend is the cash flow that is received by the investors. So that's the reason the dividend discount model could be the first choice model. Then it also accounts all the reinvested earnings because it is looking at the profit the company has made and the dividend that it has distributed, and whatever is the non-distributed portion of the dividend, it is reinvested back for the growth of the company with an intention that the company will make better profits in the next year and it's going to generate higher profits in the next year, resulting in higher dividends in the future years. So at any point also, even when we talk about selling the share, right, someone who is buying it at this point, his intention is value this share based on the present value of the future dividends that are going to come from here onwards. When I have purchased it here, I must have evaluated the share based on the present value of the future cash flows from here. But because I have held it up to here, I might have got all the benefits, all the dividends during this period. Now, if I want to sell it here, the value of the share is nothing but the present value of the future dividends from here onwards till the future. So even if I am selling, I really need to get this kind of a price, which is the present value of the future dividends that are discounted at the cost of equity. Now, a few important points regarding the dividends. Compared to the earnings, compared to the net income, they are less volatile. Generally, the companies have a stable dividend policy. Even if their profits are much higher or much lower, they try to maintain the dividend in a particular region itself. So the dividends are less volatile, and even the short-term fluctuations during a boom versus a recession, probably your net income can change drastically, but the dividend that the company is declaring might not be changing so drastically. So that's the reason we say dividends are less volatile. And dividend generally is a reflection of the long-term company value, because the dividend policy that has been designed is simply to keep in mind that the company is going to grow at a particular rate. It's a reflection of the long-term company's value, because it will take into consideration the rate at which the company is going to grow. It will take into consideration, it will offset the fluctuations of the economy. So it is much more a reliable model as long as the company is declaring a dividend in line with the long-term growth of the company. But on the limitation side, if I look at, for a company that does not pay dividend, it's not that easy to apply this model, right? So that's one place where I have to look out for an alternative, because the dividend forecast for those companies, even if I say, okay, in the future they are going to pay dividend, even if I go with that assumption, the probably that the risk that comes in is from when they are going to pay, how much they are going to pay, what would be their first dividend, when would be the first dividend be made. All these things lie as uncertainties. So because of that, it becomes very difficult to use a dividend discount model to value those kind of companies which are paying which don't pay any dividend, or which pay a dividend very less compared to their typical growth rate. Now, the other way of looking at dividend discount model, it generally takes the approach of the minority shareholder, like you and me, who are buying a very small number of shares, which does not even constitute 0.01% stake in the company also. Very minority shareholder kind of an approach, where I don't even have any control over the timing and the amount of the dividend. The reason being, it is purely guided by the dividend policy of the company. And as I have already said, the dividend policy is purely based on a stable stuff rather than the volatile profitability of the company. So here one thing we have to see is the dividend policy of the company, which is adopted by the controlling interest, means the majority stakeholders. They are the ones who are setting the dividend policy. So the majority stakeholders who have a controllable interest in the company, they are designing the dividend policy. And if the way they have designed the policy is in line with the profitability of the company, so if the company has generated a very high profit, probably the dividend declared is much higher and vice versa. So if the dividend policy is more or less in line with the profitability of the company and the value creation of the company, then I can very much rely on the dividend discounting model. But probably the dividend discount policy, the dividend policy has nothing to do with the firm's ability to create value. Dividend is not in line with the profitability of the company. Then it's better that you don't use the dividend discount model for valuing the firm. And if the company is having a history of paying out dividends consistently, better use the DDM for doing the valuation of that particular firm. If the company is having an established dividend policy, dividends are in line with the profits of the company, better go ahead and use the dividend discounting model for the valuation of that particular firm. And to a large extent, if the perspective of valuation is from a minority interest perspective, you and I buying very few number of shares which don't even constitute, let's say, 0.01% of stake in the company. In that case, it's better to use a dividend discount model itself for the valuation purpose. So these are the different scenarios or the positions of the company where a dividend discount model is more appropriate and where it is not at all appropriate, right?